If a senator buys defense stocks right before a major military contract gets approved, the public should know about it. If a representative sells bank stocks right before a financial regulation gets announced, that should be visible. But here's the thing. Most people don't read these filings. They're buried in PDFs on a House or Senate website. They're not headlines. They don't show up in your brokerage app or your news feed. And by the time they're public, the trades are already weeks old. The member has already bought or sold. The price has already moved. You're looking at history, not a real-time signal. But I went through the July batch because I wanted to see if there were any patterns, not because I think every congressional trade is some kind of inside move. Most of them probably aren't. But because when multiple members in different committees all move in the same direction at the same time, it's worth asking why. It's worth asking whether they're seeing something in their briefings or their data access that the rest of us aren't seeing yet. And what I found is that in late July, 3 separate members, 2 from committees that oversee financial regulation and tech policy, 1 from an appropriations subcommittee, all filed disclosures showing sales of positions in large cap tech stocks. So you had a sector that was priced for perfection, facing rising regulatory risk. And then you had these 3 members who have access to non-public briefings on enforcement priorities and economic forecasts, all selling within the same week. That's the context. That's the setup. Now let me walk through what specifically they sold and why I think it's worth paying attention to. Here's what gives me pause. When I looked at the specific positions they exited, it wasn't just broad index exposure. These were concentrated bets on individual mega-cap tech names. One member sold a position in Microsoft valued between $50,000 and $100,000. The disclosures only give ranges, not exact figures, which is another frustrating limitation of the Stock Act reporting requirements. But that range tells us this wasn't a trivial position. For a member of Congress making a base salary of $174,000 a year, a $50,000 to $100,000 stock position represents a meaningful chunk of their net worth. Another member sold Alphabet in the same range. The third sold Meta and Amazon in smaller positions, each in the $15,000 to $50,000 range. These aren't diversified ETF sales where you're rebalancing across sectors. These are targeted exits from the names that have been the primary drivers of the S&P 500's gains over the last year and a half. Now, why does that matter? Because if you're a long-term index investor, and most of the people watching this are, your portfolio is heavily weighted to these same stocks. The S&P 500 is market cap weighted, which means the biggest companies get the biggest slice of the index. It's not an equal distribution. It's not 500 companies each getting 1/500th of the weight. The top 10 companies in the S&P 500 make up roughly 35% of the entire index, and 7 of those top 10 are tech companies. As of mid-2026, the top 7 tech stocks, the ones people call the Magnificent Seven, made up roughly 30% of the S&P 500's total weight. Microsoft alone was sitting at about 7%. Apple was around 6%. Alphabet, Amazon, Meta, Nvidia, and Tesla made up the rest. So if those names roll over, the index rolls over with them. You don't get to opt out of that exposure unless you're actively choosing to underweight tech or hold equal weight funds, which most people don't. And here's the part that concerns me most. These members didn't just sell in a vacuum. They sold during a period when the data was starting to show cracks in the AI growth story that had justified these valuations. In late June and early July, we started seeing reports that enterprise spending on AI infrastructure was slowing. This is critical for understanding why tech stocks are vulnerable right now. Higher rates for longer means higher discount rates on future earnings, which hits growth stocks the hardest. And tech is the ultimate growth sector. These companies are valued based on expectations of earnings 5, 10, 15 years out. When interest rates go up, the present value of those future earnings goes down. It's a math problem. If I promise you $100 in 10 years, That's worth more to you today if interest rates are at 2% than if they're at 5%. The higher the rate, the less that future dollar is worth right now. So when the Fed says rates are staying higher for longer, that's a direct hit to the valuation of growth stocks. So you had valuation risk, you had regulatory risk, and now you had growth risk, all converging at the same time. And these three members, who sit in rooms where they hear about enforcement timelines and economic projections before the rest of us do, all decided to exit their tech positions in the same week. Now, I want to be clear about what I'm saying here and what I'm not saying. I'm not saying these members broke the law. I'm not saying they traded on classified information or insider knowledge. The Stock Act allows members to trade. It just requires disclosure. And there's no evidence in these filings that anything illegal happened. But the law doesn't require that trades be based only on public information. It just requires that they be disclosed. So it's entirely possible, and in fact likely, that these members have access to briefings and data that informed their decision to sell, even if that information isn't technically insider information in the legal sense. What I'm saying is that this is a data point. It's a signal. And when you combine it with the macro setup, the valuation pressure, the regulatory headwinds, the softening AI spending data, the Fed's stance on rates, it's a data point that suggests caution might be warranted. It suggests that the people who have the most access to non-public policy discussions are choosing to reduce their exposure to the sector that has driven the market for the last 18 months. That doesn't mean you should panic. It doesn't mean you should sell everything tomorrow, but it does mean you should be asking yourself whether your portfolio is positioned for a scenario where tech underperforms or where the market leadership rotates away from the names that have been winning. So what does this mean for you practically? Here's how I'm thinking about it, and here's the framework I'd use if I were sitting in your position trying to decide whether this information should change anything about how I'm investing. If you're a long-term index investor, and by that I mean someone who's putting money into a 401k or an IRA every month, someone who's planning to hold these investments for 10, 15, 20 years or more, I don't think this is a reason to panic sell your S&P 500 or NASDAQ funds. That's not what I'm suggesting. The whole point of index investing is that you accept you can't time the market. You accept that there will be periods where the market goes down, sometimes significantly, and you stay invested anyway because historically over long periods, the market goes up more than it goes down. You stay diversified across sectors and companies so that no single bet sinks you. You don't try to jump in and out based on headlines or short-term signals because the data shows that most people who try to time the market end up worse off than people who just stay the course. These congressional trades are a yellow flag, not a red one. They're not a fire alarm. They're not a reason to abandon your plan. But they are a reminder to check your exposure and make sure you're not over-concentrated in one sector just because that sector has been the winner for the last 18 months. Because here's what happens psychologically to a lot of investors. You start with a balanced portfolio. Maybe you're 60% stocks, 40% bonds. Within your stock allocation, you're diversified across sectors. You own tech, you own healthcare, you own financials, you own consumer goods. But then one sector, in this case tech, goes on a massive run. It doubles while everything else is up 20%. And suddenly, without you doing anything, without you making a single trade, your portfolio is no longer balanced. Tech has grown from 20% of your stock allocation to 40%. You didn't choose that concentration. It happened passively because of price appreciation. And now you're sitting on a portfolio that's much more exposed to one sector than you ever intended to be. So here's what I would actually do with this information. One, look at your portfolio's tech weighting. If you're holding a standard S&P 500 fund, you're sitting at roughly 30% tech exposure right now. That's just the reality of a market cap weighted index in 2026. The biggest companies are tech companies, so they get the biggest weight. If you've also got a NASDAQ 100 fund or a QQQ ETF on top of that, Or if you own individual tech stocks like Apple or Microsoft or Nvidia, in addition to your index funds, your real exposure could be 40% or higher, maybe even 50% if you've been actively buying tech because it's been the winning trade. That's a lot of eggs in one basket, especially in a sector that's facing regulatory headwinds and valuation pressure. It doesn't mean you need to sell. It doesn't mean tech is going to crash tomorrow, but it does mean you should be aware of the concentration risk. You should know that if tech has a bad year, your portfolio is going to have a bad year, even if the rest of the market is fine. Two, if you're still adding new money to your portfolio, if you're dollar cost averaging into your 401k or IRA every month, consider whether you want to tilt some of that new money towards sectors that are less crowded. I'm talking about utilities, consumer staples, healthcare, financials. These are sectors that have lagged tech over the last 2 years, which means their valuations are more reasonable and their dividend yields are higher. You're not trying to time a crash. You're not saying tech is going to zero. If inflation stays sticky, if core PCE keeps coming in above the Fed's 2% target, and the Fed holds rates higher for longer, that's a headwind for growth stocks. It's a headwind for tech. And watch the regulatory calendar. If the DOJ or FTC announces new enforcement actions, if they announce breakup proposals, if they start imposing fines or restrictions that hit revenue, that's a direct hit to the valuations of the companies these members sold. Now, I want to be really clear about something. This is educational content. This is not personalized financial advice. I'm not telling you to sell anything. I'm not telling you to buy anything specific. I don't know your financial situation. I don't know your time horizon. I don't know your risk tolerance. I don't know whether you're 25 and just starting to invest or 55 and getting close to retirement. Those details matter. They matter a lot, and they change what the right move is for you. What I'm doing here is walking through how I would think about this information in the context of a long-term strategy. I'm showing you the framework I'd use to evaluate whether a signal like this should change my behavior. But if you want advice tailored to your specific situation, if you want someone to look at your actual portfolio and tell you what to do with it, you need to talk to a licensed financial advisor who knows your full picture. The bottom line is this: congressional stock trades are one more data point in a much bigger mosaic. They're not a crystal ball. They're not a magic indicator that tells you exactly when to get in or out of the market. They're not a reason to abandon a sound long-term plan that's based on your goals and your risk tolerance. But they are a reminder that the people with access to non-public information are making moves. They're a reminder that the insiders, the people who sit in the rooms where policy gets made, are responding to risks that may not be fully reflected in market prices yet. And it's worth asking whether the risks they're responding to are risks you've accounted for in your own portfolio. It's worth asking whether you're positioned for a scenario where the last 18 months of market leadership reverses. It's worth asking whether you've let your portfolio drift into a concentration that you didn't intend and wouldn't choose if you were starting from scratch today. If you want to stay on top of these filings, if you want to keep tracking what members of Congress are buying and selling, and if you want me to keep breaking down the macro signals that matter for long-term investors, subscribe. I'll keep going through these disclosures as they come out. I'll keep connecting them to the bigger economic picture, and I'll keep giving you the framework to think through what it means for your own strategy.